Welcome back to another edition of This Week in 3 Minutes. I've called this one SDR Gold Peg. Well, some people are concerned about the price of gold action. The action this last couple of weeks have been unsettling for some and even demoralizing for others, but I'm not the least bit concerned. It's still well within its long-term 28-month trend since the end of 2015, in fact, and comfortably above that major support. Dipped down below the short-term support this week, but I see it rising today. I'm not the least bit worried, and I'll tell you why. By the end of the summer, we're likely to find out the after effects of what's going on right now. We learned that last month, Russia dumped half of its U.S. Treasury holdings, 50% or about $50 billion in U.S. Treasuries into the market in exchange for physical gold. Why? Well, they claim that it's because rising yields are causing the current holdings they have to fall in value, and they want a greater diversified allocation to reserves. A mix of better assets, not just the U.S. dollar. And who else is likely to do the same thing but, of course, China? Of course, China's being, probably prodded to do this by a sharp stick with the tariff flag on it. But maybe they claim they're doing it for the same rational, logical reasons. The value of their current U.S. Treasury holdings are falling, and they want greater diversification. And, of course, they're going to buy gold with it, just like the Russians are, just like other BRICS countries are going to do. Physical demand for gold by dumping large volumes of treasuries is no doubt going to put upward pressure on the price. Although this is intriguing, Chris Powell from GATA this week forwarded me a very, very interesting article that Jim Rickards is working on, something to do with his upcoming book. But Rickards has uncovered or discovered or been introduced to the strange peg that the price of gold has had to the SDR since the Chinese currency joined the SDR, or the IMF will allow the Chinese currency into this reserve settlement tool known as the SDR, that the IMF doesn't even call a currency. But the fact that the gold price is basically in lockstep with that international reserve asset suggests that we may have been, since October 2016, in fact, on some kind of hybridized gold standard. This is kind of shocking to me, and I don't know exactly how to effectively explain it, because what goes on at the highest levels of central banking is above my grade, folks, above my pay grade. So I don't know exactly what this means or how this plays out, but in the coming weeks to months, hopefully I'll be able to get a better handle on explaining it. But it would seem for the time being now that at least in SDRs, the gold price is stable, extremely stable. Meanwhile, it's going all over the map in other currencies. So stay tuned. I think we're going to be in for a really interesting fall, and I think a reflection of what's going to be going on happened this week. It was announced that General Electric, which had been a component on the Dow for 111 years, is no longer part of the Dow. They have been substituted by some other company. I can't remember the name, doesn't matter. And I wanted to point out something, that the value of that index, if you were to look at it 111 years ago, none of those companies are on the Dow anymore. The Dow would in fact be worthless, because they substitute. It gives the indication that the Dow has been constant and consistent, but it's not. They're constantly moving companies on and off the Dow. That's one of the things that's how the Dow works. Whereas with gold, there is no substitute for the real deal. And if you had a gold bar from 111 years ago, it would still be a gold bar in your hand. If you were holding a certificate of the Dow from that day and listing the companies, none of those companies would be on that list. So think about that for a second as another reason to own gold. There's no substitute for it. So on that note, have yourself a wonderful weekend, and we'll see you next Friday. Cheers for now.